fell particularly on those least able to bear them. So beyond monetary policy, what fiscal policy can do is it can provide, this is taxing and spending, can provide direct targeted income support for groups that really need it. And there hasn't been a bigger need for it in a long, long time here. And those powers to tax and spend are strictly the province of our elected representatives in Congress. They get to decide who bears the costs and who gets the benefits of those things. And it's essential in our system that it be elected representatives who do so. And in the CARES Act and a couple other bills they passed, this is the largest and fastest response to any downturn since the Great Depression. It was quite large, and I would say overall effective. Don't expect perfection from a bill that's written, at warp speed, if you will. But nonetheless, this was very strong, and I think that the stronger recovery that we've had is in particular a function of that. I'll just add that questions of financial sustainability arise. Can we afford these deficits and that kind of thing? And those are issues we're going to need to return to as a country. We won't have a choice. Ultimately, we will return to those issues. They're not issues that I would prioritize now. The time to be focusing on fiscal sustainability is when unemployment is low, when the economy is growing, when taxes are rolling in. And that's the time to really focus is during the healthy part of the business cycle, not when the unemployment rate is high and millions of people are out of work.
But Jay, as you balance the fiscal versus the monetary, there are long-term implications to either path. In choosing one over the other, it's going to determine what the future that we face is going to be. So given the choice, which way would you go to minimize the negative impacts of too much debt or too much of a too great deficit?
Yeah, I don't see it so much as a trade-off. I would look at it this way. So I think the question with fiscal policy is, have you done too much? And, is that going to, put us on a path to an unsustainable fiscal path? The truth is we're already on one. It's not an emergency. The way you get back on a sustainable path is you have the economy growing faster than the debt for a long, long period of time. That's what a successful program looks like. And we will go to work on that when the economy is ready for it, I would hope, in a perfect world. And that's the way that'll work. In terms of what we do, we use our emergency tools. So we have particular tools, the lending tools that we've used to lend to state and local governments and non-financial businesses and others. Those are all available with the permission of the Secretary of the Treasury under unusual and exigent circumstances, which means in an emergency. So we're using them. When the time comes, we'll put those tools away. And no one wants the Federal Reserve to take over the function of private lending in the economy. These tools are only available when the private lending markets break down, and they did in March and April. So we came in, and the markets have reopened, and when the right time comes, and I don't think that time is yet, or very soon, we'll put those tools away, as I've said. So, and there shouldn't be any long-term effects of that. I don't think that monetary policy, the whole point is for us, the goal for us is to support maximum employment and stable prices. Neither of those goals is put at risk in the long run by the actions we're taking now. Far from it. We're actually doing what we can to hasten our progress toward those goals.
Well, let's focus on the Fed side of the equation for a moment. The balance sheet of the Federal Reserve Bank has grown from $900 billion in 2007 to over $7 trillion today. In 2012, when the Fed started to taper, there was the taper tantrum. And in 2018, there was another tantrum with respect to the autopilot that was announced, a program of slowing the buying of securities. So how and when do you see the Fed getting the balance sheet back to some sense of normal, by which I mean neither stimulative nor restrictive policy?
Okay, so Alex, I would say it's really premature to even think about normalizing to think about the size of the balance sheet and things like that. We're focused for now on achieving the goals that Congress has given, maximum employment and price stability. And we'll start to think about when it's time to slow down our purchases, which would slow the growth of the balance sheet, and take further steps going forward. We'll start to think about that when there's been a whole lot more progress toward those goals. But I would say, based on our experience, some of which you mentioned, we do know the steps to take, and we know that we need to carefully communicate those steps well in advance. And what we wound up doing after the global financial crisis was, in 2013, we announced that we would gradually taper our asset purchases, so they ended about a year later. So gradual move. And then the size of the balance sheet was held constant for several years. And as the economy grows, then the ratio of the Fed's balance sheet to the size of the economy shrinks. So that's what we can do. I would also say, though, in terms of, I won't go into all the detail, but what really sets the size of the Fed's balance sheet in the longer run is the public's demand for our liabilities. This probably isn't widely understood, but what the Fed is like a bank in the sense that we have assets and liabilities. We're like a small bank, except we're not small, but our balance sheet is actually less complicated than a commercial bank's is. And so we have our principal liabilities that make up for most of our liabilities are currency. And everyone knows what currency is, and the public demands that. Of course, currency is an asset in the hands of the public, and also bank reserves, which is just commercial bank deposits at reserve banks. So, and those are assets to the commercial banks, but to us, they're liabilities that we issue. So, ultimately, a lot of the growth in the balance sheet after the global financial crisis was because of increasing demand from the public for currency, and even more than that, increasing demand from the banks for bank reserves. And the reason there was so much demand for bank reserves was that banks were required to hold very much higher quantities of highly liquid assets. And one of the most favored kinds of highly liquid asset, all of the assets that we create are effectively risk-free. So they're very popular for banks. That's where a lot of the growth of the balance sheet came in. But ultimately, that's a question we will return to, and we'll use, we have a playbook, and we'll no doubt we'll improve upon it. But we know, I think, how to normalize policy over time. And one key is telegraphing everything you're going to do well in advance to avoid surprises, and then moving very slowly.
Well, let's talk about growth for a moment. We're in a global economy, and there are global factors that are influencing the growth of the U.S. economy, such as demographics, productivity, savings rates. How are these global factors, including technology, impacting your view of monetary policy?
So I guess I'd start by saying our economy is always evolving. And these are powerful and sustained global forces that you're talking about there. And they've led to fundamental changes in our economy that have important implications for the conduct of monetary policy. So we have a strategy document, and we write down what our strategy is. It's called our consensus statement. And we write down what we call our policy framework. And that needs to evolve to meet challenges. If you look back, as you can remember well, Alex, the challenge 40 years ago, of course, was high and rising inflation. That's what essentially central banking was about, was reestablishing credibility for getting inflation under control. And under Paul Volcker, the Fed managed to do that. Since that time, central banks around the world have done the same, and using a framework called inflation targeting. The challenges keep evolving, though, and for much of the past 2 decades, many central banks around the world have been struggling with too low inflation. And I know that's highly counterintuitive. I know for our Fed Listens events around the country that too low inflation is a challenging idea, but nonetheless, inflation that is persistently too low can pose dangers for the economy. And to see why that is the case, lower inflation means lower interest rates. And every interest rate is included an estimate implicitly of future inflation as well as a real return. Lower interest rates mean that the central bank has less room to react and less power than to support the economy in a downturn. That imparts a downward bias on economic activity employment and inflation. And we've seen this exact dynamic whereby low rates lead to weaker activity and lower inflation become a self-reinforcing disinflationary trend. We've seen it happening around the world, and we really don't want that dynamic to take root. And I guess I'd quickly touch on four principal changes that have emerged over recent decades, and I would say now amount to the new normal. The first is for these advanced economies, the growth rate, the trend growth rate is lower than it used to be. That's because population growth is lower, and its productivity growth is lower. Secondly, as I mentioned, the general level of interest rates has fallen around the world. And on a happier note, we saw, and some other nations did as well, over the last couple of years, historically low unemployment and really labor market conditions that were essentially unprecedented over the last 50 years. And we saw, importantly, that the benefits of a really strong labor market began to flow in the last couple of years to those at the lower end of the income spectrum. So more of the wage gains went to people at the lower end of the income spectrum. You saw labor force participation, which is a critical statistic that the United States lags in. It moved up against all predictions, and particularly for minorities and women. So it is really hard to overstate the societal benefits of a strong labor market. So that's the third thing I would point to. And the last thing is we saw all of that without seeing inflation, troubling inflation. Of course, inflation barely responded to that. In an earlier time, there was a tight connection between very low unemployment, 3.5% in this case, around there for a couple of years, and inflation. That connection we knew it was weak, but we had to live through it to really see how weak it was. So we took all of that in mind. My colleagues and I actually conducted the first ever public review of our monetary policy, strategies, communications, and tools, and announced the results this summer. And we made some, I think, quite significant changes to our policy framework and the way we think about the job that we do for the public. First, we said we looked at everything we learned, and we decided to think of maximum employment as a broad, inclusive goal, meaning we will look at not just the headline number, but maximum employment implies that you're looking at minority unemployment rates and other unemployment rates, not just the top line. We also said that we would only react to shortfalls in employment. This sounds, technical, but essentially, we would say if we have an estimate of what maximum employment might look like, if we're short of that, then of course we would keep rates low. But what we're saying is even if we go past that estimate, that alone will not be enough for us to raise interest rates. We will wait till we see actual inflation or other trouble. On the price stability side of our mandate is maximum employment and stable prices. We reaffirmed that our long-run goal remains inflation of 2%. But to achieve that, we need to keep inflation expectations anchored at 2%, and to achieve that, we need to achieve inflation that averages 2% over time. And to do that, following periods when inflation runs persistently below 2%, we will aim to achieve inflation moderately above 2% for some time. This is all new for a central bank to deliberately aim to overshoot, and what it amounts to is a robust updating of our framework, again, in response to the fundamental changes in the structure of the economy that we've seen evolving persistently over the last few decades.
Well, so Jay, let's combine these two issues of global factors that are playing in the U.S. economy and putting the U.S. economy in global perspective, and the whole concept of increasing the inflation target. Is that going to impact the dollar and therefore put in jeopardy the reserve currency basis of the U.S. dollar?
I think that's quite unlikely, certainly in the foreseeable future. Over the past few decades, there's been discussion of that. People have thought maybe SDRs, which are associated with the IMF, or the euro or the renminbi, would challenge the dollar's role. It hasn't happened. The role of the dollar as a reserve currency, financing currency, invoicing currency around the world just hasn't changed over the last couple of years ago. Our dollar markets, treasury and currency markets, are the deepest and most liquid in the world. More than that, though, to be the reserve currency, if you look at our dynamic economy and financial system, look at our open capital markets, our strong democratic institutions, including an independent Federal Reserve, those are the things that really make the dollar a safe and reliable currency. And as long as those things remain true, as long as we're that country with those institutions, and then the world will choose to see the dollar as a leading reserve currency, or currently really by far the leading reserve currency. Of course, if you look through history, different currencies, it tends to be a persistent role, but it's not permanent. We have to, be those things to continue to warrant that status.
So we have a few more minutes, so I'm going to have to ask you to go through kind of a lightning round here, Jay. So
okay.
let's talk for a moment about the responses during the Great Financial Crisis, how the Fed responded to the Great Financial Crisis and its regulatory capacity, and how it's different this time. How would you characterize the banking system today vis-a-vis during the Great Financial Crisis?
So we spent a decade or more with the banks, strengthening the banks, much higher levels of capital, much higher levels of liquidity, a better sense of the risks they run and how to manage them, stress testing, resolution planning. And this time around, I'm happy to say that so far, the banks have held up well. They absorbed a tremendous amount of deposits coming in at the beginning of the pandemic. They also made a ton of loans as customers pulled down on their lines of credit. We can't. No one can be complacent about this. The banks have taken big reserves against potential losses that they expect. But I think until we're well and truly through this, no one can be in a position of being complacent, including the banks and including the supervisors and regulators.
I got it. So you've been with the Fed since 2012, first as a governor and now as chair. What have you and your colleagues learned? How has the Federal Reserve changed during your tenure?
The big part the big learning, I think, is the economic learning that came. I came in 2012, and you didn't really know at that point. It was impossible to know at that point whether those factors that I talked about were going to go away or were going to be persistent. I mean, I still thought that the economy might go back onto its old growth track, and many people did. It didn't, and it didn't happen anywhere in the world really among advanced economies. So that's the main economic learning. It's slower growth, lower productivity, lower interest rates, disinflationary pressures around the world, but a lot of benefits. I'll go in a different direction there, though. The thing I think that the other thing that's sunk in, and this shows up in surveys, is that large public and private institutions around the world have really struggled to hold on to the trust and faith of the public. And that's government, that's big businesses. And so I really think that it's on us to aggressively seek in our democratic system transparency, accountability, and hence democratic legitimacy. So we work really hard to reach out to the public and particularly to their elected representatives in Congress who have oversight over the operations of the Fed. We've greatly increased our interactions with members on both sides of the aisle in the House and the Senate. And our approach is to say, we'll tell you what we're thinking. We really, we want to understand what your concerns might be and listen carefully to them. And so I think if you're not doing those things and aggressively seeking transparency and accountability, you're courting trouble in this world where, generally speaking, the surveys show people are losing faith. That's the other thing I think that's become quite clear in the last decade.
Well, congratulations on what you have done there to advance that transparency and clarity for the Fed. And let me conclude with one final question, and that is about income inequality. We have characterized this recovery as a K-shaped economy where people at the bottom end have been disadvantaged and possibly permanently disadvantaged. What is the Fed's role here, and how can you turn this around and make America a more equal country?
So income inequality is obviously a big economic and social issue in our country today. And we have, I would characterize an important but limited role in reducing inequality. Of course, really to address these longstanding deeply rooted problems of disparate outcomes by racial and gender lines and those sorts of things. That's going to take a response across government, across the society. So the biggest thing we can do, we do quite a bit of economic research analysis on the status of these issues and also on what's causing them. So we have a big operation here that's very focused on just analytics, and that informs, we'd like to think it informs the public dialogue. More directly than that, though, I would go back to the way we look at maximum employment. We saw the benefits of a strong labor market, a 3.5% unemployment. It was really 4% for a long time. Anything in the category of unemployment that's in the 4s or the 3s is a strong labor market. And we saw the benefits falling to people who have really not participated as much in the benefits of the recovery until then. And it took 7 or 8 years to get there. So we need to do better than that. And to do that, we need all of government working on it, including monetary policy and fiscal policy. But our new framework, of course, is calculated to get us as quickly as possible back to a strong labor market, and to be very patient in raising interest rates when we do so. And the idea is that will contribute. It will certainly contribute to better economic outcomes, even though our tools, of course, can't be targeted at individual groups. But nonetheless, that approach to monetary policy should, at the margin, address inequality as well.
Well, Jay, I want to thank you. What I take away from our discussion this morning is the Fed's continued commitment to engagement, your commitment to transparency, your caution about complacency, and your determination to get our country back on a growth trajectory, and all of the underpinnings that are involved in accomplishing that. I thank you for joining us this morning. I appreciate it. I look forward to seeing you in person in 2021. All the best, my friend. Take care.
Thanks for having me here today, Alex. Pleasure to see you.
Great pleasure. So if the audience will click on the exit button and go into the next session, I will see you there. Thanks, Jay.
Thanks, Alex.